Walk into any grocery store in America and watch what happens at checkout. Swipe, tap, insert. Almost nobody pulls out cash. It feels smooth, harmless, even responsible. You earn points. You build credit. You get fraud protection. It feels smart. But here's the part most people don't see. According to data from the Federal Reserve Bank of New York, total U.S. credit card debt has crossed the $1 trillion mark. Nearly half of cardholders carry a balance month to month, meaning they're not just using cards for convenience, they're borrowing at interest. So the real question isn't why don't people just pay it off? The better question is, why has borrowing become normal? This isn't just about bad habits or overspending. There's an economic reason, a psychological reason, and a structural reason behind it. Once you understand those layers, you'll realize Americans aren't randomly choosing debt. They're operating inside a system that quietly encourages it. Let's start with the foundation. Income versus expenses. For decades, wages in the U.S., when adjusted for inflation, have grown slowly compared to the rising costs of housing, healthcare, childcare, and college tuition. Research from the Economic Policy Institute shows productivity has increased dramatically since the 1970s, yet typical worker pay hasn't kept pace. Now think about modern expenses. Rent in major cities can consume 30–50% of income. Health insurance premiums and deductibles continue rising. Groceries and utilities fluctuate. And so what happens when your paycheck covers 90% of your life, but not 100%? That remaining 10% doesn't disappear. It gets financed. Credit cards quietly fill the gap between stagnant earnings and expanding costs. Not because people are reckless, but because monthly math doesn't always work. When income growth trails living expenses, borrowing becomes less of a choice and more of a pressure valve. And over time, that temporary solution turns into a revolving balance. Now here's something ironic. In America, to be considered financially responsible, you have to borrow. The FICO credit scoring system measures how you handle debt. Your score improves when you use credit and pay it back consistently. A big factor is credit utilization, how much of your available credit you're using. Another factor is payment history. If you avoid credit entirely, you don't build much of a score. Without a strong score, you may face higher mortgage rates, expensive car loans, or difficulty renting apartments. So from a young age, people are told, open a card, use it, build your credit. The system rewards controlled borrowing. It doesn't reward total avoidance. That creates a loop. You use credit to qualify for better financial opportunities. But using credit increases exposure to interest if balances aren't paid fully. It's not just about consumption, it's about access. And once borrowing becomes tied to opportunity, credit stops being optional. It becomes part of adulthood. Now let's talk about the brain. Behavioral research from MIT found that paying with credit cards reduces the pain of paying compared to cash. When you hand over physical money, your brain registers a stronger emotional response. With a card, that reaction softens. Why? Because the loss feels delayed. When you swipe, nothing visibly leaves your hand. The consequence comes weeks later as a statement. That gap weakens the connection between action and cost. Then there's the minimum payment trap. Statements highlight a small required payment, making the larger balance feel distant. Psychologically, that reduces urgency. Add rewards programs, cashback offers, airline miles, and spending feels incentivized rather than restricted. None of this is accidental. Credit cards are engineered for convenience and frictionless transactions. So when Americans reach for plastic, it isn't just habit, it's behavioral design. The system reduces emotional resistance, making borrowing feel smoother than spending money you already have. Here's a less talked about reason: emergencies. Surveys from Bankrate and the Federal Reserve's SHEED report consistently show a large portion of Americans would struggle to cover a $1,000 unexpected expense without borrowing. Think about that. Car repair, medical bill, sudden travel, job interruption. In countries with stronger social safety nets, unexpected costs are often partially absorbed by public systems. In the U.S., many expenses fall directly on individuals. Medical debt alone affects millions of households. So what becomes the backup plan? Credit cards. For many families, cards aren't used for luxury purchases. They're used when something breaks. They act as a short-term financial cushion in the absence of savings. But when emergencies happen repeatedly or income is unstable, balances accumulate. Living on credit in this context isn't about shopping sprees. It's about navigating unpredictability without a strong financial buffer. Now follow the money. Credit card APRs often exceed 20%. If someone carries a balance, interest compounds monthly. That creates steady revenue for issuing banks. Meanwhile, companies like Visa and MasterCard earn interchange fees on every transaction. The more people swipe, the more volume flows through the system. Rewards programs aren't random generosity. They're designed to encourage frequent usage. More transactions increase fee revenue. Revolving balances increase interest income. Late fees add another revenue stream. In other words, the ecosystem benefits when people keep using credit, especially if they don't fully pay off balances. This doesn't mean there's a conspiracy. It means incentives matter. When corporations profit from borrowing behavior, marketing, design, and structure naturally align around encouraging usage. Debt isn't a glitch in the system. For financial institutions, it's a business model. So why do Americans live on credit cards? It's not a single reason. Wages haven't matched living costs. The credit scoring system rewards borrowing. Behavioral psychology makes spending painless. Emergencies demand quick solutions. And financial institutions profit from revolving balances. When you layer those factors together, debt stops looking like a personal failure. It starts looking structural. That doesn't remove responsibility, but it changes perspective. Understanding the mechanics gives you power. You see where pressure comes from. You recognize design patterns. You understand incentives. And once you see the system clearly, you can decide how you want to operate inside it. The conversation isn't about blaming individuals. It's about recognizing the environment shaping their decisions. Because when borrowing becomes normal, the most important question isn't who's careless. It's who benefits. If this changed the way you see money, hit like. Subscribe for deeper breakdowns on how the system really works. And I'll see you in the next one.